Hi everyone, I'm Karan and welcome to Karan's Gyan. The stock on focus for today is LIC Housing Finance. As you know, LIC Housing Finance released their quarter 4 results today, and the results were worse than what the market was expecting. The key takeaways of the result are: LIC Housing Finance quarter performance reflected the prolonged pain in the real estate sector. As you recall, in the video of Indiabulls Housing Finance, I told you that housing finance as a sector has been facing a serious and a drastic downturn since last year, and this result is merely a reflection of that same pain that real estate sector is facing. The housing finance company reported a 39% drop in net profit, and this drop was higher than what analysts had expected. Now you need to understand something about results. Now market always has some expectation, and as long as that expectation is fulfilled, the market won't react. However, if something that happens is contrarian to the market's expectation, the market would react to that action. So, if I give an example, for example, the market thinks that a company would do good. However, the company ends up doing better. The market would reward the company because that company beat the market's expectations. The market was believing that the company's results should be good. However, the company's results were better than what the market was believing. As a result, the share price would increase. Now, if a company is expected to do bad and that company does worse than what it was expected to do, as a result, the stock gets hammered. So now the market thought the result should be 20% less. There'll be a 20% fall in the result. However, housing finance company shocked the market by reporting a 39% drop in net profit, because of which LIC's stock price was hammered. As you know, today LIC Housing Finance's share fell by about 6%. It was simply because of this reason, because the market expected 29% drop in net profit. However, LIC reported a 39% drop in net profit. The third takeaway: the loan book growth slowed to 8% year on year. Now, how do you measure the growth of a company that is a finance based company that gives loans? You see how much loans it is giving every year and how much its loan book increasing. Now if you notice that the loan book of the company is not growing compared to what was growing earlier, you say that, well, the pace of the company has kind of decreased. It's not growing as fast as it was. So, as you see in this figure, for quarter one of last year, there was 15% growth in the loan book. However, for this quarter, there is only 8% growth in the loan book. So this says that either LIC Housing Finance is not willing enough to give away loans. It is fearful of the market, or there are not many people who want loans. I feel it's uh, it's that LIC Housing Finance is not willing to give away loans because it is at a wait and watch situation right now. But still, its loan book growth has decreased to 8% year on year. That means LIC Housing Finance is not growing at the pace it was growing earlier. Next is, now this fourth point is something we need to worry about. It says 90-day loan delinquencies have increased to 2.83%. Now, what do I mean by the word delinquency? Delinquency means, a duty. So people who take loans, it's their duty to pay back the interest and the principal on the loan they took. As a result, people who have taken loan, they haven't performed their duty, so they haven't paid back loans for the past 90 days. They haven't paid back EMIs in the past 90 days. So this has increased from 1.21% to about 3%. That means 3% of its loan amount has technically become a bad loan. You know, that means LIC Housing Finance may not see that money come back. It's a bad loan and it might have to be written off, and that's something to worry about. That says that the loan book is going from good to bad. So these are the results. This is the quarter on quarter result. Quarter on quarter result, I mean, as you know, Indian financial year is divided into 4 quarters, and March 20 is quarter 4, and December 19 is quarter 3. So I'm basically comparing the results of the last quarter to this quarter, and as you see, the net sales have decreased to have decreased by 1.53%. So what do I mean by net sales? Net sales here is the interest received by the company, because here what they're selling loans. So what they'll get a interest component of the loan back, so that is the net sales. What is interest? Interest is, now they're distributing loans, and as I told you, housing finance companies, they borrow money and they lend it out. They borrow money at a lesser interest rate and they lend it out at a higher interest rate. So, and they eat the profit between both the interest rate. So interest is the amount of interest they're paying to the loan they borrowed. This is the interest of the money they have paid. As a result, you can see the money they're getting, which is net sales. The money they're getting from the money which they have lent out to public, that is decreasing. However, the interest has increased by about 1.3%. You see, it used to pay about 3715 crores last quarter as interest to the money they borrowed, and this quarter they are paying 3764 crores as interest. So they are paying a higher interest on the money they borrowed, and they're getting lesser amount of money back from the money they lent. As a result, their net profit is affected. It's about 30% down. However, their operating profit margin has increased. This would have happened because they would have cut costs someplace. I don't know. I haven't read about it, but it's generally because of them cutting costs. That's what their operating profit is. The profit they earn because of their operations. Now I'm seeing year-on-year growth. I'm comparing March 2020 results to March 2019. As you see, their proceeds, their net sales, the money they have received as interest from the loans they have given out has increased by 6%. However, you see the interest they are paying on the money they have borrowed. So, like I told you, housing finance, they borrow money and they lend it out. So they'll be paying interest on the money they have borrowed, and they'll be getting interest on the money they have lent it out. So the interest they are paying from the money they have borrowed, it has increased by 11%, whereas the interest they are receiving has increased by only 6%. They should technically go in tandem, but they're not going in tandem, and that can be something you need to worry about. Net profit has again decreased. It has decreased by 40%. Last year they reported a profit of 700 crores, and this year is mere 400 crores. That means they're having a lot of bad loans in between, and as of now they're on the right side of it. But if the pace of the bad loans increase, they might be at the wrong side of it. And as I told you, housing finance companies are leveraged, and as long as the leverage is on their side, they'll do good. But when leverage goes on the opposite side, they'll be posting a lot of losses. So it's something to worry about, and if there is some decision taken by the management, this can be avoided. So problems faced by LIC Housing Finance. Now, like I told you, they have a loan book. LIC Housing Finance, they lend out money to people who want to buy houses, or they lend out money to developers who want to build houses. So they're financing housing basically. So about 16% of its loan book is given to developers. So developers who make apartments, who make residential areas, a lot of developers. So about 16% of its loan book comprises of loan proceeds towards developers. Now the problem is delinquencies in this category tend to rise the fastest. These developers are more likely to to not pay back loan than people who are buying houses to live in, because developers are just building houses. They can say, I don't have the money to give you, take me to bankruptcy court. Whereas common men, they fear of their house being taken away. Now, do you understand the difference? Now, a person who's living in a house and he has taken a loan on that house, he's more willing to pay that loan, because if he doesn't pay that loan back, the roof over his head will be taken away. Whereas a developer who already has a house, he must have plenty of houses. He's using money to develop more houses so that he can advertise and sell it to people. If he feels that I won't be able to pay back the loan, he'll take a firm ground and say, all right, I can't pay back the loan, take away whatever collateral I gave you, or take me to bankruptcy court. So this is the difference between developers and common men. As a result, delinquencies in this category tend to rise faster than other categories when there's stress in the economy. And as of now, I told you there's a downturn in the real estate market. Another thing is, as I mentioned, the bad loans. I explained you about bad loans here, 90-day delinquencies. These are basically bad loans. So bad loans have increased from 1.21% to 2.83%, and that is something to worry. Another thing is provision. Now, what is provision? Provision is something that, for example, provision word came from earlier days when kings used to keep some grains as provisions, so that if there's a famine in future, or if there's a bad agriculture harvest in a particular year, the grains that he has stored can be used to feed the public. So that is provision. So provision in the case of banking means uh, money for a rainy day. So, for example, if a certain component of their loan book go bad, these provisions can be used on that day. This is basically extra cash, so that they are able to pay back the interest that they borrow, like interest from the money they borrowed. You know, and so these there needs to be a certain amount of provisions to be maintained. What is worrying is the provisions against these bad loans. The cash that they keep as reserve for a rainy day against these bad loans have reduced. Now, do you see that bad loans have increased and they have lesser provisions to what they had last year? So that is another red flag. Fourth problem RBI is facing, because of coronavirus. RBI has allowed a 6-month interest holiday to borrowers, thus weakening the already weak asset quality. So this is another thing to worry. And people who have invested in LIC Housing Finance, I am not pressing the panic button from them, but if you have any shares, you should slowly consider trying to exit the share and maybe enter this company when the market is a little better. And those who are thinking of buying LIC shares, I say, do not buy LIC shares. There are better shares on the market. Please do your research better and do not lose money. Now, this is a 3-year graph of LIC share price. You see, LIC share price 3 years ago was about 750 rupees. Today is about 270 rupees. So, do you see, within 3 years, the stock has fallen by about 65%, whereas the overall market, the index, has gone up 12%. So, don't bet on losing horses, do your research well, and know more about what the company is, what industry is the company in, what are the prospects of that industry, and is there any growth in that company, or is there any growth in that industry, and research about it. All right. So, guys, this is it about LIC Housing Finance. I hope you liked the video.